Hi there. Welcome to the Introduction to Forex. Now, in this category, I'm going to explain everything you need to know regarding the Forex market so you can get a better understanding of who trades Forex and how to make money in Forex and other lessons that are really going to help you swim with the sharks in the Forex market. So, let's start the lesson by explaining what Forex really is. Forex is a global decentralized market where currencies are exchanged for other currencies. The Forex market, or the foreign exchange market, is one of the largest financial markets by trading volume, liquidity, and by value. The Forex market has a daily volume of more than $5 trillion, and it's the largest market traded amongst other financial markets. The Forex market allows you to trade currencies such as the US dollar, the euro, the British pound, the Australian dollar, the Japanese yen, and many other pairs. And it's open 24 hours a day for 5 days during the business week, and it's closed on weekends. Now, the major financial centers of the Forex market are in London, New York, Tokyo, Zurich, Frankfurt, Hong Kong, Singapore, Paris, and Sydney. That's 10. And the market can be broken down to 4 major trading sessions: the Sydney session, the Tokyo session, the London session, and the New York session. Now, historically, the Forex market has 3 peak trading sessions. Traders often focus on one of the 3 trading periods rather than attempt to trade 24 hours a day. And this is known as the Forex 3-session system. The sessions consist of the Asian, European, and North American sessions, which are also called Tokyo, London, and New York sessions. Pretty simple. So the volatility of the market depends on the Forex sessions that I mentioned. When a session closes, another session will open. So the volatility of the market will affect the currencies. And if a session isn't open yet, you can see a difference in the volatility as it's really low with no momentum in the market. But when a session opens, then the market will react to it by becoming more volatile. The United States dollar is the most traded Forex currency pair. Then other currencies come along, like the euro, the yen, the British pound, and other currencies. Now, since I mentioned some of the most traded currencies, you might wonder what affects the currency's price. As in any other market, it's supply and demand. When a certain currency is in demand, it means there are a lot of buyers. And when there's too much supply, that usually means there's a lot of sellers. So when the majority of traders in the market buy currency, they can shift the price of the currency up, so the sellers, which try to sell the currency pair to shift the price down, won't have any impact. But the price of currency pairs in the market really depends on a lot of factors that can shift the price up and down and can also manipulate the price. These participants are banks and other financial institutions, hedgers, market speculators, brokers, politicians, corporations, as well as individual traders. Beside the factors that I've mentioned, there are other factors that affect the Forex market. Now, remember, economic events like inflation rates, politics, unemployment rates, speculations especially. There are other economic factors too, which are known as the fundamental analysis. They can all have a really high impact on currency pairs in a couple of seconds. So for you as a trader, it's really important to be aware of the fundamental analysis factors that can affect the price of a currency pair. Don't worry, because in the next lessons, I'll explain fundamental analysis in detail, and I'll provide examples of fundamental analysis. Now, here's an example, though, of a currency exchange. Let's say George, living in the United States, and in the summer, he traveled to Germany as a tourist to explore the German culture, and he stopped by a coffee shop to buy some coffee. The currency that George has in his wallet is the US dollar. Now, in Germany, the US dollar is not the primary currency, so he can't pay for the coffee using the US dollar currency. So, the only way to pay for the coffee is to exchange your dollars to euros. He can go to a local exchange to convert the dollars to euros, then pay for the coffee. That's how the currency exchange works in our daily lives. The same applies to the Forex market. You can exchange 2 currencies against each other, And these two currencies in the Forex market are known as currency pairs. Now, a currency pair on the Forex market is the quotation of the currency unit against the other unit of currency. So let's use the euro and the US dollar currency pair as an example right here. You'll be able to better understand it. If the currency pair euro USD is valued at 1.19, that means that 1 euro is equal to 1.19 US dollars. So here's an example of another currency pair, the US dollar and the Japanese yen. If this currency pair is trading at 104.26, that means that 1 United States dollar is equal to 104.26 Japanese yen. Pretty simple, okay? After you've learned how to read the value of currency pairs and how currency exchange works, we'll learn about how you can make money in trading, because your goal is to make money, right? So let's assume that you want to buy euro, as the euro currency is gaining value against the US dollar currency, while the US dollar currency is weakening against the euro because of today's economic situation. Well, the price that you bought the euro USD currency pair was 1.19. So if the value of the euro USD currency pair rises above 1.19, then you're going to make money, because the euro currency is gaining value and you have bought euro. Meanwhile, the US dollar is losing value. But if the value of the euro USD falls below 1.19, then you're going to lose money, because you've bought euro as you predicted the value of the euro is going to go up. But in fact, in this example, the US dollar is increasing its value and the euro is losing value. So in Forex trading, there are common terms and concepts which I'm going to use in my examples. And make sure you write them down on paper so it'll be easier for you to memorize, okay? The first two terms I want you to write down are buy order and sell order. A buy order. When you're buying a currency, you're also opening a buy order on the market. Buy in the Forex market is also known as long, bullish, or bull. Then there's the sell order. When you sell a currency, that means you open a sell order in the market. And sell is also known as short, bearish, or bear. Hopefully you were able to understand what Forex is and how it works. Now, in the next lessons, I'm going to start explaining the basics of Forex.